Welcome back. Death cross definition: how and when it happens. A death cross is a technical chart pattern that occurs when a security's short-term moving average crosses below its long-term moving average. It is often considered a bearish signal and is closely watched by technical analysts and traders. Here's how a death cross happens. Moving averages. The death cross involves two types of moving averages: the short-term moving average and the long-term moving average. Common choices are the 50-day moving average for the short term and the 200-day moving average for the long term. Crossing point. When the short-term moving average crosses below the long-term moving average, it creates a crossover point on the price chart. This crossover point is known as the death cross. Bearish signal. The death cross is interpreted as a bearish signal because it suggests that the security's recent price trend is weakening or reversing to the downside. It may indicate a potential shift from a bullish to a bearish market sentiment. Confirmation. Traders often look for confirmation through other technical indicators or price action before making trading decisions based on the death cross. This can include monitoring volume, trend lines, or other chart patterns. Applicability. The death cross is commonly used in the analysis of stock markets, but it can also be applied to other financial instruments like currencies, commodities, or indices. It's important to note that while the death cross is widely followed, no single technical indicator can guarantee future market movements. Traders and investors typically use a combination of technical and fundamental analysis to make informed decisions. Conversely, there is also a bullish counterpart called the golden cross, where the short-term moving average crosses above the long-term moving average, signaling a potential bullish trend reversal. Thanks. Bye.